and to that end I do work with a number of corporates and startups to try to place as many talented students as possible. So for those of you that do work diligently towards good outcomes, I dare say I'm more than happy to help in that respect as well. Okay? Just a few housekeeping matters at the very beginning. If you'd like to touch base with me, these are my particulars. My preferred mode of communication is Skype for Business. Skype for Business is a very useful tool. How many of you have installed Skype for Business on your computer? Formerly Microsoft Link. It's a very, very useful tool. I'd encourage you to install it on your computer. You have a free license through the university. So please feel free to go down to the software catalogue page and download that. Okay? It's a very good way to communicate. It's a very robust solution. It's not dissimilar to traditional Skype or Google Hangouts, so it's very, very easy to use. But it's used a lot in commerce and industry, and so it's good practice anyway. You'll be able to see where I am if you log into Skype for Business. It'll actually tell you where I am on campus, which is also quite a helpful thing if you'd ever like to touch base. Beyond that, you can contact me on that number, 92446231. On the occasions that I'm out of the office or consulting, it'll redirect to my phone anyway. Okay? Please, I would encourage and implore you to leave full and complete messages. I do find from time to time, let's be frank, I do find about 50 to 70% of the time, students will leave a message just saying, hi, lovely to talk with you, please call me back, without any details. And then 2 weeks later they'll come rather upset looking and talk to me about the fact that I never called them back. And there's a very simple reason for that, and that's that I don't have any of your details. Okay? So please, when you are leaving a message, I know that sounds very, very silly, but it happens far too frequently for me to not say this. If you could leave a full name and a phone number. Don't leave a student number because it's very hard to discern. Very hard to actually hear a very long student number over the course of that amount of time. Beyond that, it's also problematic from time to time when students leave a message with a name that isn't on my student register. Okay? So if you include a message that has a name on it that isn't on my student register, very, very hard for me to reconcile. Okay? So try to leave just those particulars if you can. For those of you that are interested, again, my background outside of Deakin was working with organisations in treasury operations like Ford Motor Company, and then subsequently with PricewaterhouseCoopers, and then running technical programs at CPA Australia and ICAA. I continue to sort of do work for industry organisations like that to this day. Beyond that, I also have worked with a number of management consulting organisations outside of the finance context as well. So again, if you ever have any interest in any of those sorts of spheres or disciplines or areas, please do feel free to pop over and have a chat sometime. I guess in terms of research, I know that you're probably not interested in this in any way whatsoever, but in terms of research, my focus is largely in machine learning and econometrics. So if you have an interest in machine-based prediction, predictive analytics, mathematical finance, computational finance, which I'm sure you will do because they're fascinating areas, again, a door's always open to have a chat about those sorts of things as well. Probably want to hear a little bit about the course at this stage. The course itself doesn't have many required readings. There's a textbook that I've made available on the cloud. You can download it and print it. Okay. Sometimes you'll find that the on-campus print services with open textbooks, they're not aware that you're allowed to print them. You can just tell them to email me, and I've said that it's okay to print them on campus. It's often easiest to just go down to print services to print out a copy for about $5. That way you have a copy on hand for you. You could certainly keep an electronic copy as well, but it is actually quite helpful having that digital copy. All right, so the unit itself is constituted by a series of assessments that you're probably very, very familiar with. Don't be daunted by the word simulation. It's just a very, very simple simulated workflow environment where you'll just be making some decisions, not dissimilar to the type of decisions that you would make in a multiple choice quiz. So in terms of the decision process and the actual simulation itself, it might look a little bit different, but in terms of the assessment, it's not dramatically different to what you would have already experienced. The assignment, is quite a unique one in some respects because you get to determine what you're going to be writing about. There are a number of suggested topics provided, but it's very much a research essay, research report type assignment whereby you guys will nominate a particular topic or field of focus, and you'll frame, I guess, an idea or a topic around that, and you'll write a report to that end. So, for the most part, it's a reasonably straightforward endeavour. The final examination is just an exam not dissimilar to the ones that you would have experienced up to this point in your careers, given that you're all graduate students. It is generally constituted by around 7 to 8 two-part questions. Okay, more often than not, those questions will come from the final 8 topics, 6 topics thereabouts of the course. So the vast majority of the material comes from the more applied aspects of the program. There isn't a huge amount of theory, albeit around 30 to 40% generally. I know everyone hates theory, but there's always going to be theory on every paper. It's kind of unavoidable. Beyond that, there will be some weekly readings. It's not going to be any more than one chapter, which generally speaking will be around 30 to 40 pages. Okay, so it's not a huge amount of preparation, but it is helpful to do that preparation in advance. I will provide you or send you all via email a summary of the readings themselves, but more often than not, each weekly reading, don't listen to that, each weekly reading correlates directly to a particular chapter, okay? The very minimum, the bare minimum that one should do in preparation for the course is read the lecture notes. As a very, very loose guide, that is the bare minimum one should do in terms of preparation. Historically, students can do quite well and do quite well in this unit. I'd like to think in part because it's well taught, but also because it's a little bit interesting. With that said, though, you can certainly still fail, and a good number of people do, and it's largely because of a lack of preparation, if history is any guide. Okay? So, we are going to be doing some finance today. We are going to be talking about all things finance for a little while. Our focus today is very, very rudimentary. Historically, the goal was to try to get to know you guys as much as possible, but with modern graduate cohorts this size, it becomes a little bit problematic. This might surprise you, but there was a point in time where graduate cohorts were around 20 to 30 students in most graduate courses in this country, and now they're well over 200 to 300. So it does make that aspect of the course a little bit more challenging, but I would like you guys to sort of feel comfortable in this context, even though it is a fairly large group, and I will concede people aren't often as comfortable talking in open outcry in a group of this size. With that said, that is my goal, and hopefully over the course of this session you come to become a little bit more comfortable with both the material and myself, such that you can ask the necessary questions over the course of the next 12 weeks. In today's discussion, we're going to be talking about the origins of financial markets. Our goal is to very much orientate your thinking around what we're going to be covering within this course and the core focuses of the course itself in a broad sense. So this is very much like a précis or a summary to the entire course. Okay? So we're going to be providing you with a broad overview of each and every element that we're going to be talking through. Beyond that, we're also going to be introducing you to a number of key financial assets and key financial instruments that you'll need to become familiar with over the course of the trimester. And come the end of the session, you should appreciate the level of integration that exists between markets now. Modern markets are very deeply integrated and very, very complex. Very different in the way that they're now constituted in comparison to old markets. All right, so at this point, ordinarily, I'd like to probably get each person to introduce themselves, but in a group this size, that would probably take up the entirety of the session. So I might just sort of do a quick sort of discussion exercise whereby you guys can perhaps introduce me to what you're doing just with a quick show of hands, if that's okay. So I'd like to just sort of gauge from within this group, just with a quick show of hands, how many of you intend to work in the financial services or, how do I put it, the sort of structured finance, the investment banking, general banking industry after you complete the course, with a quick show of hands? Okay. Okay, and how many of you are accounting majors? Okay, there's a reasonable number of accounting majors. And how many of you are kind of undeclared or a little bit undecided at this stage? Everyone? Okay. No, it's nothing wrong with being undecided at the start of a degree. It's why you do one. All right, so that's good to know. How many of you have a financial services background, meaning that you've worked in financial services, or for argument's sake, you've completed an earlier degree in commerce with a finance or economics major? Okay, so quite a good number of you. So for many of you, much of what we cover today is going to be not that different to much of what you've already covered in previous courses. You probably come to discover that week 2, week 3 is perhaps where we introduce some more kind of high level or advanced level concepts. All right? Just a quick sort of show of hands. How many of you intend to do a professional certification when you complete or during? Okay, I should probably introduce them. So how many of you will do CFA, CPA, or CA? Okay, okay. And of that group, how many would be CFA only? Okay. Okay, not many. All right. Well, just at the outset, it might be very, very worthwhile that I just sort of talk to you about how I see most people's career trajectories sort of playing out. This is your first year within the program, right? Year 1. Most people, when they're recruited at the end of their first year or the beginning of their second year, okay? Which means that T2 this year and T1 next year, in the context of a 2-year degree program, are the most important trimesters, even if you're looking to go back and work in a country of origin. If, for argument's sake, you were to work abroad, they would still be your key recruitment phases, all right? So more often than not, people will enter into a program and they'll complete a year's worth of study, more often about a year and a half's worth of study, and then I'll get a lot of frantic emails, T2 of year 2, which is when most people start to look at internships and placements. The reality is the vast majority of work is already allocated at that stage. So at this point in your time, I know it seems very, very early, you need to really be thinking about these trajectories. What am I going to be doing T2 and T1 of next year? Okay? Am I going to be starting CFA? Am I going to be looking at a charter in accountancy? Am I going to be doing a third-party certification? A simple introductory certification like BAP or Bloomberg or CAPM? You know, something that would take me a relatively short amount of time. Am I going to be applying for associate roles in T2 of this year? Okay? You can't apply for associate roles next year. You won't be eligible anymore because you won't be in your second final year. Okay? So all of these things are things that you need to actually be thinking about right now. And look, I'm probably the only person that's going to be talking to you about this, to be frank. It doesn't mean that it's any less important, okay? The non-academic stuff matters far, far more than the academic stuff does, all right? You can get straight HDs and still not get an associate role if you don't apply the right way or at the right time, all right? So bear that in mind when you're doing all of this study. All right, so this course is a course in financial markets theory and practice. So our goal in this course is to introduce you to important institutions, markets, and instruments that you will have an interplay with. Over the course of your careers, many of you are going to have, quite literally, dozens and dozens of different secondments across different spheres and industries. It's unlikely that the thing that you do when you complete your studies will be what you do several years down the track. So our goal here is to really introduce you in a broad sense to every facet of the market. So when we talk about financial markets, we're essentially talking about the interplay that exists between financial institutions. Okay, I'm guessing when we think financial institution, we probably think of bank as being the sort of center point of the financial services industry. But in truth, there are many important institutions. We have our NBFIs, like finance companies, merchant banks, money market corporations. We have those that carry risk, general insurers. We have life insurance agencies. We also have other important subordinate agencies, like government-based insurers, government-based financial services institutions. And we then have contractual savings institutions and bodies like superannuation funds and pension funds. All of these institutions play critical roles in the context of the broader financial system. In Australia, we actually have a series of non-banks that are almost as substantial in asset size terms as our banks. And you'll find that this is an evolving trend. You'll find more and more countries start to see these secondary institutions as becoming more significant. All right? So in Australia, we actually have $1.4 trillion in funds under management through our management funds industry. Okay, $1.4 trillion. It's kind of a hard amount of money to fathom. Okay, to put it in perspective, we have one of the smallest populations in the world, but that is the 4th largest wealth endowment of any endowment anywhere in the world. I'm originally from India. The level of pension savings in India is in fact lower than the wealth endowment that's available in this country at present. That's astounding to me. Why is that the case? Why is it the case that the wealth endowment in this country is larger than all but 4 OECD member countries? Any thoughts? Well, we have a mandated superannuation program. We were one of the first countries in the world to initiate a mandated superannuation program. So the Hawke-Keating government in the 1980s, in their infinite wisdom, they determined that it was a good idea to encourage all organisations to put some money away. And as a consequence, we now have a wealth industry that's almost as substantial as our banking sector. Again, there are a huge number of work opportunities in that industry, just by virtue of the sheer size of the industry that you guys can avail yourselves to. All right, what about the markets themselves? Well, in this country, we have a number of very deep and liquid markets. The market for shares is a very, very active one here. Australians are hugely enamoured with share-based investment. Australia and South Korea rank atop all other nations when it comes to participation in equity markets. So Australians buy more shares on a per capita basis than any other member of any country in the world. Okay? But the figures around the world are increasing. You'll have a look, for argument's sake, at countries like India, like Brazil, like China. Their participation in equity markets is increasing dramatically as well. So these financial markets are critical to the broader operation of the financial system. The equity markets facilitate the exchange of ownership. But as we speak, even the structure and complexion of equity markets is changing. What has happened in recent years to give rise to substantial change in the way that people raise money? Any of you guys been thinking about this? Because you're literally kind of entering into the financial services sector at a time of almost significant or seminal change. It's kind of exciting. What's been happening within the financial services sector in recent times in relation to fundraising? What has changed? As lovely as my voice sounds, my dulcet tones sound, this class will get really, really boring if I'm the only person talking. Any thoughts? So who follows the financial services press? Anyway, one of the key things you need to start doing is a free copy of the Financial Review that you can get from the library. Just go down there and grab it for a little while. Have a read. It'll get you up to speed on these sorts of issues. Being in Australia, you're kind of lucky. There's a really intriguing movement in relation to financial services technology. Just because we have such a banking sector oligopoly, it's kind of straightforward in some respects to create new technologies and work with a major bank to innovate in the financial services sector. So we actually have a huge fintech segment in this country that's a really active one. If you're interested in connecting with them, more than happy to connect you with. They're actively engaging in innovation in a number of different ways. But the primary changes to fundraising have come from legislation. Okay, so I'm guessing there are a lot of people from India and China in the group. What has the Chinese Department and the Chinese Ministry of Finance and SEBI in India been discussing in relation to changing fundraising laws? There have been substantial discussions in both of those countries over the last 3 years about major changes to fundraising laws. Changes that have already been enacted in Australia. What are those changes? Any thoughts? What are those changes? Okay, it's going to be one of those classes, I can tell. All right. Well, okay. The primary change relates to the laws that allow you to avail yourself to a fundraising mechanism. So prior to the advent of crowdfunding laws, okay, the only way that you could raise funding or money from the general public was how? through a Yeah, that's exactly right. Through an initial public offering, an IPO. That's the conventional mechanism through which you would raise funds. By virtue of changes to crowdfunding legislation that were first enacted in Europe and subsequently in the Americas, we've now seen similar legislation enacted in Australia that allows people to use a non-broker intermediary to raise money from the general public. This is a remarkable shift when you think about it. We've not seen such a major change to securities legislation since 1947. But no one in finance is talking about it, because it takes a while for people to start talking about important things. This is a very important thing, because truth be told, this is a mechanism through which people can avoid an IPO. If, for argument's sake, they're able to effectively raise money through a Series A, Series B funding round, and then go to the market through a crowdfunding mechanism, why would you need to go to IPO in the traditional way? It would only be to ensure that current owners can divest their holding. All right, so this is a dramatic shift, something that's being discussed in India and China at present. Both China and India have suggested that they will have crowdfunding laws in place over the course of this year, potentially sometime next year. So all of a sudden, two of the fastest growing economies in the world are now going to allow small enterprise within those countries to raise money without using a public fundraising mechanism. I think that's pretty remarkable. It's a pretty seminal shift within the financial services industry. All right, what else is happening in the context of markets? It's kind of critical. We're seeing a decentralization of credit. We're seeing credit raised, we're seeing funds raised and monies raised for lending purposes through far more decentralized means. All of a sudden now, we're observing new enterprise, new firms, innovators raise money and engage in lending in a very non-traditional way. So in Australia, we have firms like Prosper and others that are trying to actively compete with the banks by providing a direct credit service without the physical banking infrastructure that comes with it. So all of a sudden, we're seeing a shift in relation to fundraising and a shift in relation to lending. 2 years ago, when I took a course of this type, I can recall talking about the fact that these things were going to happen. Well, they've now happened. All right? How is that going to impact traditional banks? I can tell you categorically, when costs are driven down, people will start to look at non-traditional lenders. Okay? Why do you go to a bank at present? What is the advantage of going to a bank? Sorry? Yeah, you go to a bank because you need funding, but if you could go somewhere else, would you go somewhere else? What would be the key determinant of that decision? This is important because it's going to drive where you guys work in the future and how you work. Well, that's exactly right. And certainly in places like India and China, where cost is arguably the most critical determinant, decentralized financing sources like this, okay, non-traditional intermediation is going to be the way of the future, and it's already happening. It's already happening in those contexts. I would say there's more decentralized financial services innovation in China and India even than in Australia. Some of the stuff that's happening in India around localized lending is truly remarkable. Particularly phone-based lending, intermediated lending that happens through non-traditional technology. Yeah, they're really sort of leading the way. Okay? So these are things to be thinking about in the context of markets, how markets are changing, how they're evolving, how it's going to affect my workflow, how it's going to affect my own future, for argument's sake. Those of you that are thinking about accounting careers, think for argument's sake about how opportunities in those segments are evolving as well, because they're evolving even more rapidly. Okay? All right, when it comes to financial instruments, for the most part, you will be familiar with most of the instruments that we're going to be talking about in this course. In this course, we're going to be valuing bonds, we're going to be valuing bills, we're going to be valuing shares, we're going to be valuing term loans. Okay, traditional instruments, not that different to the instruments that you're familiar with. All right? What are we going to be doing a little bit differently? We're going to be looking at some of the innovations that have been occurring in recent times around certain instruments. So we'll talk about equity warrants, very, very popular throughout Asia, an Australian innovation. We're going to be talking about options contracts and more, for lack of a better description, exotic instruments as well. Okay? And you'll learn about how to price them. So what is the goal of a financial system? Okay, in this first we can keep our training rules on nothing too complex. The goal of a financial system is really to bring together the key stakeholders, the institutions, the instruments in the market, and to create a fluid mechanism or system through which securities can be exchanged and monetary resources can be exchanged. In the simplest sense, we might say the goal is to bring together surplus units and deficit units. All right, surplus units and deficit units. Those that have more and those that have less. All right? Those that have excess supply of funding want to make that available to those that don't at a price. That's the goal of the system in the simplest sense. But it's important to appreciate, I guess, for lack of a better description, the historical origins of these systems, and we'll do that in a moment. Arguably, in the context of any financial system, the most important category or element of the system is the asset category. All right? When we're talking about financial assets, we're making reference to a broad category of both securities and non-security assets. All right? So people often get confused when using this terminology. You'll find even textbooks will confuse this terminology, but the term financial asset is a broad umbrella concept. It's a construct that is very, very broad. All right? So what is a financial asset? A financial asset is a financial instrument or a medium of exchange. Okay? So a currency or financial instrument can both be considered a financial asset. So think of that as a broad category. So if I was to use a car analogy, I would say that the term financial asset is akin to the concept of a car, okay? And each of these sub-elements is like a type of car, like an SUV or a sedan for argument's sake. So one is the umbrella concept and the others relate to subdivisions or different categories, all right? Currency has been around for an incredibly long period of time. I actually wanted to bring some in today. I might bring it in next week. But some old world coinage that you guys can have a look at, because I think it's kind of remarkable to appreciate just how long some of these things have been around for. So coinage has been around for well over 2,000 years. All right? So people have been creating coin-based representations of value using various precious metals and even non-metals for over 2,000 years. Okay? When it comes to currency in the modern sense, even currency in the modern sense can be traced back for hundreds and hundreds of years. So, arguably the first modern form of currency was issued in Venice in the 14th century. Okay? During the mercantilist period in the 14th, 15th and 16th centuries, many banks and non-banks actually issued paper-based currency. Okay? The first currencies were not issued by governments. The first backed paper-based currencies were not issued by governments. They were issued by private enterprise. Okay? And they represented stores of wealth that could be exchanged. But if we go back further still, you could look at the early dynastic movements in China in the 11th and 12th centuries for evidence of the first true currencies. Monetary value was recorded on parchment and endorsed by each dynastic leader to facilitate the exchange of value. So when one dynastic leader wanted to facilitate a transactional exchange with another, they would represent value not in physical form, but on a parchment with their endorsement. And that was considered to be of the equivalent worth. To possess that piece of paper was to possess all of what it backed and supported. Okay? So things evolved, obviously, through time to the mercantilist period, where banks got involved and they started to endorse currency. They issued currency in their own names. All right? And that currency could be used to facilitate major transactions. And you mightn't be aware of this, but ancient Italy was a very, very important part of the world, particularly Venice. Venice is, in some respects, considered the origin of many modern aspects of accounting. Certainly the origin of double-entry bookkeeping. Okay? Why did double-entry bookkeeping exist? It existed because we had all of these financial instruments and transactions to account for, and they needed a system to do that. So as a result of this elevated activity level in terms of financial services, a system was created known as bookkeeping or accounting. You could actually find records from 1642 that talk about the origins of the first bookkeepers, first accountants. Okay? So that's the relationship, I guess, between the origin of finance and the origin of bookkeeping. The first financial instruments needed to be accounted for, and so these mercantilist-type bankers, they needed to create a system to do that, and they created the double entry framework, which you now use. So accounting is not a new thing. Finance is certainly not a new thing. If you trace back its origins to arguably the earliest modernist time, well, I shouldn't say modernist, the earliest modern incarnation, you might say the 12th century is the origin of finance in a broadly modern sense, and the 14th, 15th century is the origin of accounting. So these things have been around for a very, very long time. Shares have been around for an incredibly long time as well, all right? How long have shares been around for? What was the first joint stock company? Well, think back to social studies. Everyone would have learnt this. Sure, everyone from India would have learnt this. What's the first joint stock company? History is valuable. Okay, I'm really, really big on numbers, but I can tell you right now, the reason people stuff up so much when it comes to work in modern times is because they forget things that happened in the past. Okay? I think it's the naivety of every generation to assume that things have never happened before. For example, this most recent global financial crisis, a lot of us feel as though things like that could never have happened before. I can tell you categorically as you go through this course, we're going to chart the many occasions where these things have happened before, almost with common or identical origin. Okay, so what was the first joint stock company? All of these anecdotes, they help you remember the important things, trust me. Okay, think back to when it was really, really hard to engage in trade and commerce on your own. Think back to a time in history where people needed to rely upon each other, arguably far more than they do now. Right, yes. That's exactly right. And during a time of barter and exchange, it was very, very important to have supportive structures that were supportive of collaboration. So what do you think was the first joint stock company? Have a think about it. All right. I would say between the 15th and 18th centuries, India was a very, very important part of the world. Why was that? It still is. Don't get me wrong, it still is. But it was very, very important back then. Why is that? See, there you go. Yeah, it's the... so you didn't answer my question, you answered my earlier question, but that's why. So the answer is Dutch East India Trading Company. That was the answer to the first question. And why was India so important at that point in history? Because it controlled a substantial amount of trade and commerce by virtue of the availability of key resources. The spice trade, but also mineral-related trade. Okay, there was a huge gem-based industry in India as well. And so all of that trade and commerce was facilitated through what is known as the Indus River region, which is now modern India. And everyone wanted to engage in trade and commerce with India. But what was challenging about that? What was challenging about engaging in trade and commerce with that region, that part of the world? Well, it was easy for China. China and India facilitated trade quite easily because they have a shared border. But those in Europe couldn't do that, could they? Why is that? Just because of the geographic distance, the sheer distance between both key sets of ports. So it was determined that a trade route needed to be established between key parts of Europe and in India to facilitate trade and commerce. But no one could fund this on their own. Okay? We're talking about the equivalent quantum of money to buy Google, Microsoft, Apple, and Lenovo. Okay? That was how much it was going to take to establish this trade route. This was like creating intellectual property in the old world. And so no one wanted to fund it on their own. So what happened? They created a new system of ownership. Prior to that point in history, all enterprises existed for defined purposes. You came together as a group in your community because you wanted to build a bridge, because you wanted to construct a building. You had a defined purpose. You would do that, and then the collaborative group, the collaborative entity would cease to exist. All right? Through the Dutch East India Trading Company and the subsequent East India Trading Companies, of which they were 7, people don't talk about that in social sciences, okay, but 7 other companies were established to do very, very similar things shortly thereafter. People could come together and all contribute funding and all benefit from their investment. All right? They created the first joint stock company whereby people could own a portion of the enterprise. But this is what people often don't talk about. That trading company existed only to establish the trade passage. It didn't actually exist to engage in any subsequent trade and commerce. We're talking about, by virtue of size, probably the greatest enterprise in history, the largest corporation that has ever existed. Okay? It wasn't meant to exist for more than the initial weeks required to establish the trade passage. Why did they make the decision to change the model and establish the first corporation? If nothing else, you'll know how to do a lot of financial maths after the end of this course, and you'll be able to regale people at dinner parties with really, really interesting conversational pieces like this. All right? If nothing else, I'll prepare you for that. So why do you think? Why do you think they would choose to create an enduring enterprise? Well, look, it just made sense. It was profitable. Very, very simple premise that underlies that decision. It was so outrageously profitable. Everyone just said, hey, let's not end this. Let's keep this going. Let's create a new form of enterprise. That was the first corporation, the first joint stock enterprise that was a going concern. You heard that expression before? Going concern? That's where the expression comes from. Okay? The concern would be ongoing by virtue of the profit it is generating. It is a going concern. In accounting, they never tell you where all these terms come from. More often than not, they come from finance. All right? That's their origin, because an accountant needed to account for something that was going on. So they created a concept known as going concern to define a non-ending enterprise. All right. And some really terrible things happened. We don't need to talk about the history of Dutch East India Trading Company, because it's pretty terrible. All right. They were effectively given, through the European councils and various legislative bodies, the authority to operate as a separate nation. Okay, so they were given more power than any corporation in the history of the world. And at one point in history, they employed over 1.4 million people. It would be the equivalent of having around 23 to 25 million employees now. Okay? So it didn't all end that well. Okay? But from that, we saw the origin of the share concept. The joint venture going concern gave rise to the modern ordinary equity concept. Okay? Why do you think it's called ordinary equity? It comes from an Elizabethan English term that happened through happenstance, through circumstance, several hundred years later. Okay, so we had the Dutch East India Trading Company. We then had several rivalrous entities created. We then had the refinement of the joint stock company to the ordinary equity concept. So it's an old Elizabethan English term, okay? It's actually used probably more commonly now in India than it is anywhere else in the world, because India is one of the few countries that still uses bond paper and parchment paper, yeah? That was how it happened everywhere else in the world, okay, since the 14th century, all right? So, corporations went from being non-enduring to being ordinary equity-based enterprises. So ordinary equity relates to the notion that we have an equitable stake or equitable interest in something. The first equitable stake, equitable interest-based companies involved owners having an equitable stake and equitable interest, and also non-owners. And that's why we use the concept of ordinary equity versus general equity. Okay? We all have a general equitable stake in so many things in society. Okay? We want to see good outcomes in the context of so many things in society, and we have a general equitable interest in those good outcomes. But an ordinary equitable interest related to a specific ownership stake within that company that entitled us to all the benefits of all other ordinary owners. That's where the term ordinary equity comes from. We don't even use the term in Australia anymore. We just use the term share. you have a share. Okay? But that share concept came from ordinary equity, which became ordinary stock, which became share. Okay? So when we're talking about shares, we're talking about small pieces of ownership in the context of something much, much larger. But when it comes to modern ownership, we don't have any equitable interest in anything beyond the earnings of the company. Okay? We can't go in there and if they haven't paid us for all, we can't take a share. We can't take any of the underlying assets of the company. All we have an entitlement in are the benefits that attach to that category of owners. Why is this now the most popular mechanism through which to raise funding? Sorry? There is a cost. Oh, you mean in terms of the cost of the dividend yield, you mean? Yeah, that's okay. Yeah, so there is no formal ongoing financial obligation as there is with debt. You are correct. But one of the key reasons is that you have an unlimited supply of capital. You can keep raising money. Okay? During times of uncertainty, you can raise more money. Okay? It provides you with a security net. Okay? Moving on into modern times. Some of the largest corporations of today have had varied histories. Okay? Think of Apple Corporation. You might know this. Well, when Apple Corporation went public, it had a number of successful years. But during a period of relative uncertainty within the organization, Apple Corporation was about to cease to exist as an enterprise, and the only way it was able to facilitate its ongoing activity was to actually engage in dialogue with Microsoft. Microsoft acquired nearly 40% of the company to ensure that it would continue. Microsoft did that because it believed that Apple was a worthwhile enterprise within industry. So for a substantial amount of Apple Corporation's history, it was actually held up or moderated because of the share equity it was able to issue to Microsoft Corporation. Okay? And then as Apple got better, I should also mention what else happened. They also got a $1 billion loan from Microsoft at that time. It was around, no, was it $1 billion? No, it was around, I mean, it was an Australian billion. It was around $740 million. It was a substantial quantum of money for that point in history. So you can see how times have evolved and how things have changed. That would never have happened during the time of Dutch East India Trading Company. Okay? You wouldn't have seen one major corporation lending such large quantities of money to another to ensure their continuity. Modern corporations operate under different terms. All right. What else is worth noting with respect to shares? What are the most active and buoyant markets for share securities at present? I'm a huge fan of certain companies, certain North American companies. I'm a huge fan of Google and Microsoft, and I certainly have a like for companies like Apple and Nintendo as well. But they're not the most popular securities in the world or markets for securities. Where is it really active at present? By virtue of the opportunities that are presented in the world at present, the vast majority of interest in the world at present is in respect of securities in China and India. Okay? In China, there are approximately 1,100 companies awaiting listing on their major exchange. That is more companies that are listed on the ASX. Okay? In India, the subscription rates in relation to popular securities are absolutely outrageous. And the whole world is looking to these two countries at present for investment opportunities. Can anyone tell me, going back a little bit, looking to a major and successful transaction in Indian history, does everyone remember the Reliance IPO? Everyone remember Reliance? What does Reliance do? I love asking that question, because Indian companies are very, very different. Indian companies, Japanese companies, are very different to companies elsewhere in the world. And Korean companies to an extent. So what does Reliance do? Yeah, my answer is historically everything. Okay? Indian conglomerates are remarkable in that regard. When you talk about Tata, when you talk about Reliance, you talk about companies that effectively do everything. They're like Japanese firms like Mitsubishi or Mitsui. Very diverse holdings. The Reliance IPO, in relation to the retail segment and resources segment, was that successful that it was 11 times oversubscribed. No Australian IPO in history has been anywhere close to 11 times oversubscribed. What does that mean? It means for every 1 share in the company, people wanted to buy 11. Okay? So that is what's going on in the world, and that's why people need to be tracking China and India so closely. So we're going to be spending a lot of time talking about securities in China and India. Far more interesting than talking about what's happening in the Australian markets at the moment. All right. What are some other worthwhile securities we're going to talk about? Well, I won't dwell too much, but government treasury bonds, we're going to be talking about those in a few weeks' time. If you're not familiar with them, please make sure you attend that session because pricing them can be a little bit confusing the first couple of times. Understanding how they're traded can be a little bit confusing as well. So make sure that you make the effort to pop along. When it comes to bank term deposits, that's remarkably straightforward. I know that you're all very, very familiar with those, but they're obviously a very, very important instrument. And the reason that we take a moment to talk about them is because generally they serve as the starting point or as a point of critical importance in the context of almost every major modern financial crisis. Okay? So when we talk about the Asian financial crisis, we talk about focused lending to the property segment, okay, and the decoupling of currency. When we talk about the global financial crisis, we talk about outrageous lending to the Midwest that was subsequently reassigned, or the risk was reassigned to other carriers of that risk that then endured a lot of hardship. All right? So we're going to be spending some time talking about the pricing of those deposits, but we're going to do so in the context of those two crises. All right, when it comes to talking about an asset, we talk about return or yield, we talk about risk, we talk about liquidity, and we talk about the time pattern of cash flows. Okay? Look, I'm going to fill you in on something. Most of my finance colleagues don't like saying this, but the truth is, finance as a modern discipline is a subset of economics. Right? It just is. Right? We try to pretend that it's not. But the reality is, it's essentially part of a very related discipline. If you're good at economics, you'll be good at finance. If you're good at finance, generally, you'll be good at economics, because they're very, very related things. All right? What sets finance apart as an academic discipline, and it's only existed as an independent academic discipline, people don't like me saying this either, probably since about 1978 in North America. What makes it unique is this notion of a time pattern of cash flows. That makes finance a thing. Absent of that discussion, it's just economics. There is nothing unique about it outside of the focused attention we pay to analysing the patterning and analysis of cash flows. If someone asks you about what finance is, what makes finance finance, it's the analysis of unique cash flows. That is something that is traditionally not done in economics. Okay? In economics, we talk a lot about return structures, yield structures, liquidity structures. We use econometric tools to analyse those things. We use mathematical models to analyse those things. It's the time pattern of cash flows discussion that makes this course critical. If you're good at analysing cash flows and assigning value to them, predicting them, determining what the structures are going to be, you're going to be well regarded in industry and well valued in industry. What makes finance a future-proof industry is that. When you see the level of automation that's occurring within other segments at the moment and the drive towards automation, the reason that finances seem to have a 97% retention rate as a category of employment is because it's very hard to teach a machine how to engage in analysis and conjecture in relation to the prediction of these flows, but most importantly, in relation to the dialogue that comes with discerning this and explaining it to another human operator. All right? So finance is said to have, in terms of present industries, a 97.5% retention rate, likely over the course of the next 10 years, which is kind of remarkable. I'm not going to tell you what the figures are for the other segments because that'll sound really, really biased. Okay? But they're not as good. Okay? So let's go into the attributes in a little bit more detail. All right? By virtue of how many of you have done this before, I'm not going to dwell too long. I know that you know this stuff, and I never want to insult anyone's intelligence, but there may well be some people that need a little bit of a grounding in this area. If you do, we're going to talk about it now, and you can come talk to me about it in greater detail later. So, what is this notion of return and yield? When we talk about a particular asset, let's use a share as an example. Okay? What is return and what is yield in this context? Return and yield. Let's think. No, please continue. Well, truth be told, you'll find, and I do see where you're coming from, but truth be told, you'll find that most people use these terms largely interchangeably. And I think there's generally in modern times nothing wrong with that. Traditionally, they did have slightly separated definitions, but as you'll find, there's an evolving vernacular in finance, so we generally use them interchangeably. Your definition was perfect, though. Essentially, we're talking about the largest, the excess, the amount over and above the corpus, the return. Okay? So we've invested some money. How much are we making over and above that amount of money? That is our yield. And we normally describe it in one of two ways. We describe a discrete dollar yield, we describe a percentage yield. When we're talking to a client, okay, we talk about the return of an asset in dollar terms as well as in percentage terms. It's a very common thing that we would often do. Sometimes we discuss it in relative terms, okay? So we talk about relative yield. And on other occasions, if we want to get more complex in our discussions with clients, we talk about it in terms of risk, okay? So a very common measure that we use in finance is the coefficient of variation, and the inverse is referred to as the Sharpe ratio. They're two techniques that we use to bring risk and return together, and we often use them with clients so we can compare two things. Okay? But in terms of the calculation, we all know how to do the calculation. It's the new value, how do I put it best? It's the new value less the old value divided by the old value. Very, very simple calculation. All right, what about risk? When I use the expression risk, when I make reference to this notion of risk, what am I actually talking about? Sorry? That's an excellent point. In the context of everyday speech, in everyday life, risk is the potential for loss. Undeniably so. All right? But in finance, does it mean the same thing? What is risk in the finance context? That's exactly right. So it's one of those quirky things. So the finance definition or construct, very, very different to our real-world understanding of risk. In the real world, what is risk? Risk is the likelihood for loss. Okay, so my wife hates me using this example, but if I was to walk down the street, for argument's sake, and get hit by a bus, that would be a risk. I mean, there's a risk attaching to that. People see risks attaching to flying, for argument's sake. All right, there is a potential risk associated with those sorts of things. I don't see the likelihood of me crossing the street and finding $100 as being a risk. That's an opportunity for windfall gain. In everyday life, we see that as a reward. We don't see that as in any way anything to do with risk. But in finance, it is. Okay? Finance is any variability from our expectation. My expectation in flying is to go on a flight and reach my destination. My expectation in crossing the road is to cross the road safely. It's not to have any other happenstance or circumstance, anything else arise. Okay? In finance, any deviation from our expectation is risk. Risk is defined by virtue of that central point of expectation. Okay? More often than our mean value or our average. Okay? What is the mathematical approach that we generally take to measuring risk? Very simple measure we use. What's that measure? That's, yeah, we assign probabilities to things, most certainly. And we use those probabilities to construct. Help me out. How do we measure dispersion? If I wanted to, for example, comment on, with confidence intervals or dispersion measures, the average deviation from the midpoint of the height of every person in this group, what measure would I use? The 95% confidence interval is the most popular one, and I would use standard deviation. That's exactly right. So standard deviation is the sum of squared deviations from our expectation. Sum of squared deviations from our expectation. It is the most simple measure, the most basic measure that we can use to comment on risk. There are more complex measures we're going to learn about. For those of you that do advanced financial modelling courses with me, we'll look at other volatility measures. We'll certainly spend a lot of time looking at arch, garch, other time series models. We'll spend time talking about things like bar, for argument's sake. In this course, we don't really move too far beyond this construct and beta, okay, in the context of CAPM. There are two key risk measures in this course. We're going to be doing standard deviation calculations. We're going to be doing some beta calculations. Thinking back to your undergraduate finance days, what does beta measure? Beta in the context of the capital asset pricing model. Anyone remember that one? Perfect. That is 100% correct. Okay, so the beta construct measures the volatility or the movement in a security relative to the overall market. Okay, so standard deviation is an overall measure of volatility. Beta is a single factor model of variability whereby we assume all variability derives from the market. They're the two key measures, okay, that you'll be examined on in this course. All right, what about liquidity? What is liquidity? Yep. Yeah. Most certainly. So liquidity relates to the underlying capacity for an asset to be converted into liquid form. We often have to offer a really critical caveat here, okay? And that is at a value close to its market or true realizable value. The reason we offer that caveat is because you can make almost anything liquid if you discount it heavily enough, okay? So a case in point, we generally consider residential property assets to be heterogeneous and illiquid. So differentiated, meaning that you need to look at them because they're not all standardized, and illiquid, meaning that, generally speaking, they don't sell rapidly. I would offer in the Australian property market, if you offered a 20% discount on any inner eastern property, you would be inundated with phone calls within minutes on any property-based platform because that discount is sufficient to make the asset liquid. All right? So the caveat we offer is liquidity, but in the context of its true underlying value. True underlying value is a very vague expression, so to put it a little bit more precisely, it's market value. I don't like to use a defined construct, but it's probably the best way to do it. All right, so the final concept that we're going to discuss, the final attribute of an asset, is the time pattern of cash flows that attach to that asset. Let's think back to shares for argument's sake. Shares traditionally have very, very different attributes when it comes to the provision of dividends. Okay? Different shares fall into different categories. I'm aware of firms of several of my colleagues that have gone to market in recent times that are emerging organisations that will, in the short term, not be offering a great amount of yield because they're during their earliest vestiges, their formative stages. Okay, more mature companies often we place greater expectation on. In Australia, we use certain terms to describe different categories of securities. One such term is blue chip. Has anyone ever heard that expression in the context of our market? People talking about blue chip securities. How do we describe a blue chip security relative to an emerging security? Anyone heard those expressions being used? Yep. Yep. Generally speaking, blue chip firms do have substantial capitalisation and consistent dividend yield. All right. So in Australia, our most blue chip, if we were to use it as an adjective, would be our major banks, okay, and our mining companies in particular. We have a number of substantial mining companies in Australia. In fact, one of the 3 largest and 2 of the largest 10 are in Australia. Kind of makes sense given the size of this country and the amount of opportunity there is to mine. So those securities historically have provided strong and consistent yield, such that people can be confident investing in them. We describe them as blue chip. But then we have a series of emerging securities that people invest in for other reasons. What are your drivers for investing in a given security? The time pattern of cash flows is critical to why you would invest in a given security. It probably comes as no shock or surprise that older investors and those approaching retirement would tend toward blue chip securities, those that provide consistent and ongoing yield. Some investors that are trying to construct a new fund or a new vehicle might look towards emerging securities because they provide different potential opportunities. There is the potential for a capital gain, perhaps more so with an emerging firm. Okay? So the time pattern of cash flows that attaches to an asset is critical to our investment decision. But tax also comes into play here as well. Why is tax so critical to the analysis of a financial asset and when we receive yield from that asset? Most certainly. Capital gains laws around the world vary markedly. We have some really, really great simplified laws in place in this country that were enacted around the time that we enacted changes to superannuation. So in Australia, you get a 50% discount on a capital gain if you've held that asset. Generally speaking, common law precept is if you've held that asset for more than 12 months. That's a substantial discount. So how does that influence our decision making when it comes to looking at assets and putting portfolios together for people? Let's say, for argument's sake, you're leading some high net worth investor groups, all right? You're putting together products for them. You're constructing a portfolio for them. How will you be influenced? What attributes will influence your decision making? Undeniably, the likelihood of a return and the frequency of return are going to influence your decision dramatically. If, for argument's sake, we can generate all of our returns through capital gains, that's always going to be preferable. Okay? Because of the tax advantage that comes from that. What's the challenge associated with that? Oh, most certainly. Challenges associated with focused investment activities are really important to consider. But arguably the most challenging consideration relates to the timing of the remittance of funds. Let's say, for argument's sake, you want to realise an asset. If the asset has an elevated value, but you've held it for fewer than 12 months, that's going to be considered operating earnings. Sorry, it's going to be considered ordinary earnings from ordinary concepts. It's going to be taxed in the way that all of your other income is taxed. All right? If you're going to carry it for 12 months, then you get that great discount. But the challenge is you can never predict whether you're going to get a capital gain. You can, with some certainty, relative certainty, predict whether you're going to get a dividend. Okay? So the challenge always is trying to analyse whether or not you're going to get that gain amount versus going for the certainty of dividends. Many firms have historically not been very good dividend payers. So for many, many years, Google and Apple were not good dividend payers. Apple in particular, because of what happened to it in the 80s. It took a very, very conservative approach to dividends. It just didn't pay any. People kept investing though. Apple has a very unique fan base. And those fans kept investing to a point at which the income to value multiple was at an unheard of level. You're talking about close to zero, right? But they kept investing. It was a unique quirk. The same is somewhat true of Google, albeit Google has generally always paid dividends, but just substantially smaller than they could. What happened as a result? Anyone know what happened? That has adjusted there. Have you noticed Apple started paying dividends now? Do you think it's done that because it loves you guys? Wants to pay you guys dividends? It did it for a very, very specific reason. Because a number of venture capital groups started looking at Apple's balance sheet saying, hey, we're going to buy 20% of this company and we're going to start influencing the decision making anyway. So they can either start paying dividends or we'll push for formal board appointment. That's what they did. That's why Apple started paying dividends. Because it gave one of them representation and it said to the rest of them, we're going to start paying dividends. All the venture capitalists that backed them said, hey, this is not funny anymore. All right? Someone needs to get paid soon. And now all of a sudden you see a firm that paid no dividends for 3 years paying substantial dividends as a result of shareholder advocacy. Okay? So that asset all of a sudden is perhaps not justifying its price, but getting far, far closer to it. The same is true of Google, albeit in Google's case, they just wanted an elevated dividend payment level. Okay? So that's what happens. The market starts to have its say. All the investor groups start to have their say, and they actually change the pattern of cash flows that attaches to an asset if the asset is irregular. Okay? All right. So we've talked about that ad nauseum. We've talked about that already. So we'll just take a moment now and go through the various categories of institution. Once again, this is really the entirety of the course. If you understand all of these things at the end of the course, you understand everything that you need to understand. So, in the context of institutions, you need to understand all of them in a qualitative sense. What they do, how their balance sheet is constructed, so how they source funds and how they use them, and the role they play in the context of the broader system. In the context of instruments, our focus is predominantly on equity and debt-based instruments. We'll also spend some time talking about hybrids, so convertible notes, warrants, equity warrants, fractional warrants, so on and so forth. We'll also spend some time talking about derivatives. But because we now have a focused derivatives unit in this course, we don't devote a full week and a half to it anymore. Okay? Because you can now do an entire course on derivatives. It's a really fun course for those of you that have an interest in it. Okay, when it comes to markets, we're going to be spending some time in particular talking about the capital market and the equity market. Okay? And to a lesser extent, the money market, foreign exchange and derivatives. We focus less on foreign exchange, simply because, again, it's something that you'll do in a subsequent semester. Those of you doing MAF 760, you'll probably be doing that with me. And we focus on Forex in a much more advanced way in that course. It's simply introduced at this level. All right? Fantastic. So we've talked about equity a bit. I'm not going to dwell on it too much more, other than to sort of really highlight what we've already talked about. The first joint stock companies were created because we needed the ongoing and enduring corporation concept. We needed that going concern concept. It's now evolved to become something much more modern, and now ordinary equity ranks as the most important equity classification. Just want to make a couple of things clear though. The classification here is equity. Even though we generally talk about ordinary equity, there are many other categories of equity. Okay, has anyone ever started a company? Okay, well if you've been involved with a startup, particularly in within a country where they adopt a system of law that's consistent with the Anglo-American model, you'll come to discover that there are a huge number of options when it comes to establishing a company. So in Australia, if you go to the ASIC website and you download a form to start a company, for argument's sake, you'll note that just on the standard form, there are 32 equity options. On the standard form. 32 variations on standard ordinary equity. Obviously, most people just create ordinary equity, all right? But there are many other options. You can have companies that are limited by alternative equity structures. You can have companies that are limited by guarantee. You can have companies that have a defined yield structure, for argument's sake, defined return structures. All of these things are possible. But the reality is, ordinary equity remains the most popular. And in this course, that's what we're going to be valuing. All right, so you're going to be looking at how to analyze the dividends that attach to a company to value equity. How many of you guys have done that in your undergraduate days? Used earnings-based models to value companies? Okay, that's fine. It's an interesting thing, and it's something that you will certainly use in the context of your day-to-day work and in your lives, so it's helpful. All right, debt. Why is it worthwhile talking about debt? Because debt markets are really important. In fact, they're probably as important, if not more important, than equity markets when it comes to people's everyday financial lives. We in this country are just not hugely enamoured with debt. Okay? We just never have been. I should offer a caveat. We're not enamoured with investing in debt. We are enamoured with debt. Yes, we love credit cards. Australians love credit cards, just like all other OECD member countries do, but we are not enamoured with investing in debt. If you look at our debt-based investment, even pre-GFC, we were one of the lowest in the OECD. You can't love everything. We love equity. We've always been very enamoured with equity. So a lot of money flows into equity at the expense of debt. Very, very different to many other countries in the world. If you were to go to Japan or the US, you would probably discover that if you went to a local post office or your local bank, you can buy debt over the counter. Have you guys ever watched Seinfeld? Seinfeld? No? That's probably too many years ago. There was an episode where Jerry was given a series of little debt instruments, little holder-bearer securities, bearer bonds. He cashed in. Anyone? No? It's too old? All right, I'm trying to think of something newer where you would have seen one of these. Well, look, you'll have to just believe me then. If you were to go to the local postal service in Japan, you could go to the counter and you could buy a bond at the post office. Okay? In the US, you can go to a local bank, you can buy a $100 bond. They're very popular gifts. Ask an Australian when the last time was that they acquired a bond. Or in fact, ask them what a bond is. I guarantee you the frequency of response will be dramatically lower here. We are just not interested in investing in debt, even though we participate in debt as much as any other OECD member country. That changes our markets a lot. As a consequence, people are just not hugely enamored with work opportunities in this segment. But there are a huge number. Several of my best students are working on Wall Street right now in these markets, and I encourage them to pursue opportunities in this category because so few in Australia do. So few people pursue opportunities in these segments. If you apply to work with a money market corporation or an investment bank, they will get at least 80 good applicants for every investment banking role. All right? They might get 5 for the debt markets team. I'm not even exaggerating. I can say this to you because they email me. Some of them have emailed and actually asked why they get so many here and so few there. Because people just get enamored with equity. It seems exciting, all right? But the reality is, fundraising in this market is equally important. Every major company in North America, in the Fortune 500, has had some interaction with debt-based instruments. More often than not, has raised substantial amounts of money through debt-based instruments. Google, Microsoft, Apple, all of these companies have engaged in debt-based fundraisings because they can do so cheaply. And they can just repay the debt later. It's just smart. It's better than having a bank-based facility. But what I want you guys to appreciate is obviously in the context of debt, I'm going to be talking a lot about traditional tradable instruments, like bills and bonds. But this also includes trade credit as a category, and it also includes term-based borrowing. Okay, and in this course you will be examined on term-based borrowing, understanding how a loan is structured, how to price a loan, understanding payment structures. That's something that we're going to be doing in about 2 weeks' time, okay? So, a couple of things to be mindful of. I think because there is an absence of interest in this category, it presents as a really intriguing opportunity. And I think a number of fintech firms are actively availing people to opportunities in this segment. Again, it might come as no shock, but one of the most popular new startups in finance, has anyone heard of Acorn? Who's heard of Acorn? Anyone? So Acorn is essentially a firm that takes a small amount of money after every payment that you make. It rounds off the amount, okay? And it puts it into a debt-based savings account, okay? And it invests it in debt-based instruments, tradable instruments as well, okay? So it's a really simple way to get people investing. Okay, and they raised, I think, $143 million for that idea. So they're doing okay. That was their Series A round. Their Series B round was undisclosed, but it was probably closer to $500 million. Okay, so these things are happening. People are being encouraged to consider new things. All right, hybrids. We don't devote a huge, and this is a first level course, so we don't devote a huge amount of attention to exotic instruments, but we do talk about convertible notes. Okay, so convertible notes are a popular instrument type that take the form of debt initially, but can become equity in the future. Very, very popular type of instrument as a consequence. The example I like to use in the context of a convertible note is Amazon. Amazon is a great example of a company that was outrageously overvalued in its early years, but then was subsequently undervalued for many, many years, in my view. Okay? I should offer my standard generic general investment guidance note, just so I don't get into trouble if you guys go off and invest. All the information that I provide is of a general nature. Those of you engaging in financial speculation should ensure that you check the appropriate product disclosures. All right, there we go. That's what I do if I do a corporate event. So, with that said, why is Amazon a great example of a firm that should have used a convertible note structure? What happened for Amazon's first 7 years? Amazon is probably one of my favorite companies when it comes to innovation. Okay, Microsoft and Amazon are outrageous innovators, talking about huge patent generation. Microsoft is the 3rd largest patent generator in the world, after IBM and Samsung. Okay, and Amazon, given its R&D budget, is one of the most significant contributors as well. People often don't know that; they just assume other companies rank higher. But Amazon is a really intriguing company, puts huge amounts of money, I should say, into R&D. But that comes at a cost. So what happened during Amazon's first 7 years? Really simple. They didn't make any money. Didn't make any money at all. Like, we're talking nothing. Okay? What happened to Amazon's share price every year during those first 7 years? It rose outrageously. So much so, and this is why I like Amazon and I like Jeff Bezos. Jeff Bezos came out and said, everyone needs to just relax a little bit, okay? The company is moving in the right trajectory, but we need people to take a more moderate and modest approach to the way that they view the company. Didn't make a single cent. Would you want to invest in that company for the first 7 years? I don't think that would be a smart investment. If they use the note structure, and many modern firms do, it allows them to raise money now, okay, and to pay an interest payment year on year until a defined point where that equity, either mandatorily or directly, without control or discretion, converts from debt to equity. Isn't that an ideal structure? Who wouldn't have wanted to invest in Amazon year 7, year 8, year 9? My gosh, seriously. You're like investing in Wall Street day one. Okay? It's been outrageous since then, hasn't it? So clearly the company proved itself, but people lost money in the first 7 years. We're not talking about small amounts of money, we're talking about substantial amounts of money. They went to a traditional IPO. They didn't use, lack of a better description, they didn't use the crowdfunding mechanism. They went to traditional IPO and raised billions. And no one made any money. Okay? Another example, slightly less good example, because I think Facebook is really impressive in terms of how they've been able to generate profit so quickly, but Facebook would be a similar example. I don't think that they're a really great investment at the moment. It's certainly a much better investment than Amazon was at the same stage. But the reason people invest in them is the same reason that people, were investing in Apple when Apple wasn't paying them anything. It's because they thought there was enough momentum that the share price would keep going up, even though no one's making any money. Okay? The point of difference is that Facebook has a really obvious trajectory to profit, and they're actually really impressive in how quickly they've been able to execute on this plan. But if you were given the option of investing in a note in an emergent enterprise versus investing directly, this is something that people need to strongly consider. So you'll find now that many Series B funding rounds, you guys would know what I'm talking about when I'm talking about Series A, Series B? Okay. So, are you guys all concurrently taking finance as well? Yeah? Okay. Well, you might hear this twice. In the event that you don't, the traditional funding cycle of a business is referred to in the following way. You have what is referred to as a pre-seed round. Okay? Seed capital is the initial capital that you need to build your MVP, right? Your minimum viable product. Okay? Your pre-seed round is the money that you need to formulate that idea well. Okay? So pre-seed is ideation, idea formulation. Very few people get good pre-seed funding. You have to be proven. Okay? Your seed funding round is a substantial funding round that allows you to build your business. Essentially build your first minimum viable product that you can take to market. Okay? Once you have that round, and it's normally a small round, you then pursue a Series A funding round. Your Series A funding round is your first very substantial funding round. Okay? And that's when you already have a proven product in the market. It's a scaling round. And then you can have a Series B funding round and any number afterward. But more often than not, you rarely have more than 4 rounds, and then you go to traditional IPO. Most people that engage with investment engage at the very end. With a good company, when do you want to be investing? When everyone else is at the very end? You want to be investing very, very early. And so the reality is most people aren't aware of this. Most people will invest when a firm is already an IPO, but they probably already had 4 funding rounds. People are buying the equity much more cheaply than you are. It's like Shark Tank. Anyone watch Shark Tank? Yeah? Yeah, so Shark Tank are essentially investing in minimum viable products. Early stage firms. They're like post-seed. They're like a small Series A funding round. Okay? In an ideal world, you would invest in good companies that have proven trajectory at pre-seed, but that will never happen for most people because identification is a problem. More often than not, if you get to participate at a good level, you get to participate at a Series A level. Okay, and you guys can actually do that now. The law allows you to. Crowdfunding legislation now allows you to participate very, very early. But the reality is, as an investor, if you could do partial investment, partial loan, it's a much safer bet for you. Okay? So at any point after the first funding round, if you participate with a partial loan and partial investment, it means that you will only convert the loan if the company is doing well. It protects that entire investment amount. But if they're doing well, what do? You participate as equity. All right? So many modern rounds are like this. If, for example, you look at, anyone follow Uber? Anyone catch Ubers? So I'm old, I have kids. I don't, go out and do fun things like you guys do. I'm guessing you catch Ubers to places. I catch an Uber every now and then. It's impressive technology, unremarkable, but pretty impressive overall, what they've been able to execute. Uber's 2 most recent funding rounds have been probably close to $3 billion, okay? With half debt and half equity each time. Why do you think people are doing half debt, half equity? Because Uber's not making money, okay? They're not making money yet. It seems really, really impressive, but what they're doing is really expensive. How much money did Uber spend last month? Anyone know? How much money did Uber spend last month? Okay, Uber bought $3 billion worth of self-driving cars from Volvo. They are clearly they're not making money yet. All of that money is coming from investors. Okay, and investors have now said, hey, we love your business model, Uber, but this is going to be 50% loan, 50% investment. All right, we want some return while you're figuring things out. We know that you're going to make money, make good, but why should we put another $3 billion in to make no money for 4 years? It's just not prudent. All right, so you'll find many modern investments are now more hybrid in structure. It wasn't the traditional way. People would either loan you money or invest in you. There was no middle ground. Okay? Modern investments are very, very hybrid. Okay, when it comes to derivatives, the extent of what you need to know will be covered over the course of a half seminar long session. But I'll give you a quick précis on it because it is kind of interesting. A derivative, the word itself, okay, is an interesting one. What does the word connote to you? When you see the word derivative, what does it make you think? Yeah. No, that's an excellent point. That's a perfect description of a derivative example. A gold futures contract. Perfect example of a gold futures contract. To me, when I look at the word, and with so many things in finance, I think if you're drawing blank, just look at the word. Okay? What does the word suggest to you? It's something that derives or procures or obtains, acquiesces to. It gains or garners. It takes its value from something else. It doesn't have any value itself. It's not valuable in and of itself. Its value derives from something else. It is obtained from something else. Okay, so financial derivatives are securities, synthetic securities, that have no intrinsic worth in a conventional sense. They have derived worth. Okay? Their worth derives from an underlying security. Okay? And they're incredibly popular. Okay? Normally at the end of a seminar series, people will start to want to catch up and talk about investing in this category because it is an interesting one, but it's very, very risky. All right? It's a very risky segment to invest in. And I traditionally have only ever used derivatives in the context of any organisation I've been involved with financial hedging to manage security risk, not to engage in speculation. Many modern investors obviously see it as a pure speculation opportunity. All right? So, what is a good example of a derivatives contract? Well, the example that was presented serves as a really great starting point. As an investor, I can invest in gold directly. Or I can invest in a contract that's value is based on the gold price. Gold is very popular at the moment. Why is that? Everyone keeps calling me and emailing me and asking me about stuff to invest in. And they're like, oh, someone's been telling me to invest in gold. Gold's a good investment. Why do you think that there is that mentality within the market? Why do people gravitate towards gold? Yeah, people use the expression, it's as safe as houses. I've heard so many people do that, okay, at seminars. Yeah, but isn't it as safe as houses? First of all, houses aren't that safe. I think it's a poor analogy. We've been through the GFC, we've seen what happens. But the reason that people love gold is because, generally speaking, it does have that tangibility, that innate perception of value. And you can actually trade in physical gold. You can go right now into town. There are people that do. In their rucksack, they'll be carrying their gold, and they'll be going into town to trade in physical gold. Okay? But it doesn't seem to make a whole lot of sense, does it? When you can invest in a synthetic security that derives its value from gold. Okay? So what's an example? A gold futures contract. Let's say, for argument's sake, I'm a jeweler. Very popular profession in India. Okay, lots of jewelers around, right? Tata has a major jewellery chain in India, does spectacularly well. Okay, it's a big industry for a number of reasons. As a jeweller, I'm engaged in the fabrication of jewellery. I might be concerned about an appreciation in the gold price. So what might I do? I do today, in the derivatives market, this is the best rule you'll ever hear in derivatives. If you remember this rule, you'll never get a derivatives question wrong, ever, even in your CFA exam. I do today, in the derivatives market, what I do in the future in the literal market. You remember that one rule, and you will never make a mistake. So, as a jeweller, I'm concerned about an appreciation in the gold price. Let's say, keep the number simple, the gold futures price currently is 100. Okay? So I buy gold futures now at 100. If in 12 months' time gold is more expensive, when I sell, I novate, I close out my position. Gold futures price is 120 for argument's sake. I make a gain on the derivatives contract. When I go and buy physical gold in the market to make the jewellery, it's costing me more. So I'm disappointed, but I've made a gain in the derivatives market that offsets my increased cost of production. Okay? So you can actually simplify derivatives to that one simple statement. All the complexity that people bring to the discussion can be simplified into that one simple statement. I do today in the derived market what I do tomorrow in the literal market. Just as an interesting aside, what happens to the gold price every year in November? This will help you remember what I just said. What happens to the gold price every November? Goes up. Yes, that's right. Why do you think it goes up? Most certainly. And what is the scarcity caused by? Which is from where? Why do you guys go back to, why do so many people from South Asia go back to South Asia in November, December, and January? That's exactly right. Every year without fail, the gold price shifts because of the Indian wedding season. Okay? So you'll see about a 4 to 7% bump. Regardless of everything else happening in the world, it will always increase because of the Indian wedding season. Okay, so have a look at the gold price around that time. You have to time it perfectly to generate some sort of gain, but it will happen without fail. Okay? Yep. Oh, so during the Indian wedding season, traditionally, it's, I guess, quite popular to give gifts of gold, and for the people that are getting married to, I guess, have adornments that are gold, and the sheer volume of purchasing is such that the price goes up. Cultural thing, entirely, yeah. Kind of a unique quirk to the market. All right, so I've talked to you briefly about a futures contract. There are others. The most expensive synthetic instrument will be an option contract, all less. Okay? For all intents and purposes, an option on a futures contract or an option in relation to any financial position will be more expensive. Why do you think that is? In the example I presented, with the gold price, it could have gone up or down. If I bought at 100 and the price ended up being 90, I would have been disappointed that I hedged. I would have been better off leaving it alone. That can happen. With an option, it's the right but not the obligation. The right but not the obligation to enter into the position. So you'll find that options provide what is referred to as asymmetric coverage. Coverage for the specific risk that you're concerned with. If you don't enter into the position, you can benefit from a fortunate or advantageous movement that you didn't expect. Okay, swaps are a little bit beyond the scope of our discussion for today, but in essence, the simplest swap involves the notional exchange of currencies between two parties. That's known as a currency swap. Why is it a popular activity? Well, there are many firms that incur expenses in one country but generate revenues in another. I've been involved with a number of Indian organisations that have generated revenues in Australia but incurred their expenses predominantly in India. All right? As a consequence of that, I have substantial currency exposure. Okay? And the appreciation of the rupee relative to the Aussie dollar is an example of that. One of the firms that I was involved in managing saw a 20% appreciation in the rupee over the course of a given year has a dramatic impact upon your bottom line. Engaging in a swap allows you to manage that risk. You enter into a fixed exchange rate arrangement with a counterparty from the other country, for argument's sake, that might incur all their expenses in one currency and generate their revenue in another, but they're diametrically opposed. So each generates revenue in different countries, each generates expenses in other countries. All right? So think of the Australia-India example, a really obvious one. There aren't too many firms engaged in exports to India, but there certainly are some in the context of certain things like carbon fibre and so forth that are doing some exports to India. Those two firms could engage in a notional swap. Okay? Not something that you're going to be examined on in this course. All right? Something for your knowledge. A forward contract is not that different to a futures contract. The only point of difference in reality is that it's not exchange traded. It's an over-the-counter contract. So it can be tailored to meet your specific needs. That's the only really big point of difference between the two. Okay? All good? Excellent. Let's move on. All right. I wonder if I should give you guys a break. It's week one. Would you like to finish a little bit earlier, or would you like a break? How is everyone feeling? Would you like a quick break? All right. All right. So we shall have a quick break. I dare say, is 10 minutes sufficient? Yeah? All right. So I'll see you guys back here at around 5 to, and we shall reconvene then. If anyone has any concerns, administrative issues, anything they'd like to have a quick chat about, do feel free to pop over and we can have a quick conversation. Very early for the class, I think, so I can't feel like doing the same thing. No. Sorry. No problem.
Oh, very good. And I'm telling you, it's like taking two subjects. 100%. You want all the books, so you have all the books? Okay. You might as well give it a go. Don't have to try. Do the subject. Honestly, it's because it's think about it. Everyone has a practice. Very tough. This is another point of difference. My thesis is a degree, aggregate other experiences and certifications. Mine is I don't do shit. But I actually study here and actually finance a child. So that's a skill. Or you'll see it later. Not going to pretend. What you do is always so look, I would say in both concepts, I would say very, very well. And you should genuinely use consideration. The challenge is like time, right? But I'll never expect every semester I try to get you clearly show that to me. That's a great sign, right? Last semester, one point similarity. Some things are a couple of them I got involved in certain projects. They weren't able to help us. Because it was their first year, but it was a good start. And I was happy to have them as a second year tertiary and they were able to cover it. Now I'm not sure about something. Quality. Okay, we should have a stuff. Should have a stuff. But put himself out more than just coming from finding other places. I'm from Southern Europe. it's a bit easier because but beyond that tier, it's a category. Not go or even say top tier. It's a big trust in someone. You know what I mean? Not that I don't trust other people, but you've done this and you've done this and quantitative test. And then I got it. Well, you will. But you need to practice that. Right. It doesn't have to be CFO. It could be probably a common society. Some short-term applications. Even some Coursera programs. I look at that going express. But more than CFA is all the teachers. Doesn't cost you much. The exam is what, $1,000? Once a year, this comes like half a million. What am I thinking? You can pass any other area of time that you fail for example, one, class ethics. Cannot fail. It's very hard to jurisdictions to understand. Come along and meet some of the other guys. Some of them are very it's still good. So meet generally every Monday after class, after the session. Sunday sessions. So I'll speak with you. Come along and meet some. This is your first semester? Cool. Hope it's been good so far. Okay. Very good. It'll get more interesting. More like this soon. Yes. So this is financial markets. Property investment is nearby. You look at the top? Yeah. It's more like I'm just trying to get some of the talent guys together and passionate about more than just like class work. We're just getting kind of catching up and talking about bring out some knowledge in the industry. Everyone's welcome, but to be frank, only the really key ones up. So yeah, it's just a way to get them thinking very early on about the trajectory, which is it's you out there, you know. So sort of these folks want to have some peers that have a similar mindset, and so they kind of, as they can sort of achieve things, kind of motivating them a little bit. Make sure they'll be playing because I can't always do that one section of things. The idea is that they create a good network that they can leverage for the future. And so put it in perspective, like I met a group of them now, they're all in the sort of director level, various ones about 3 weeks ago. And so, you know, it pays off like it's not a formal thing, it's more of a informal thing. Because we have formal programs for them This way it's just there will be a few more things that we have distributed, but they're not geared around certification. They're not geared around so if you'd like to hear about what we do, part of the journey. So I think it's fair. I think there's always going to be top tier work for accountants. But I think it's a much more space going forward. They're actively seeking people who want to run this life experience. So more companies are over after last year. Focus. And the other thing is that obviously these life experience is a little bit more in terms of where you're coming from and what you like to do. Once you've done that, I think contacts if you like them. Nothing at all. So obviously you do find from time to time in life, I certainly look at university or busy all the time, I think you push it very flat. Maybe I don't want to make it like 7 in the evening. Used to do a huge number of additional programs now on campus, so it's a little like session time. It's supposed to be a session time. But for students, that's the whole. So look, do that. Look, that's actually lovely to meet you.
All right. So, we shall make a start. All right, so there is a lot of new material being covered, new concepts being covered, and I dare say at times at pace. So do let me know if anything that I've said is ambiguous, or if I've conveyed it too quickly or with too much concision. So please feel free. Throw your hand up, so I didn't quite follow that last statement, and I'll try to clarify, okay? It's always important as we're getting to know each other that you guys do that. I'm jealous of the guy that has a new Alienware computer. That's cool, I like that. Is that the new Alienware? Your computer? Yeah, no, it's cool. It's got side lighting on it now. All right, sorry, I get distracted easily. No, I'm just being facetious. Yeah, a couple of things I sort of wanted to mention. It was really heartening. A few people actually came over and wanted to talk about certifications.
professional services opportunities. That's really how you need to be sort of viewing this. For mine, if you're not actively pushing all of the academics around you, all of your networks in this time, your degree program becomes a very expensive networking exercise. And the network aspect of your degree program is the most beneficial part, but you need to try to get as much value as you can in the time that you're in the degree program. So I'm going to be sticking around for a little while after class if anyone would like to have a chat about any of the professional certifications, even some of the short form certifications like Lean and CAPM, IBA certifications, IBM SPSS Modeler certifications, any of those sort of week-long certifications. More than happy to sort of talk through some of the opportunities. Beyond that, for those of you that have an interest in getting involved with things early on this trimester, next trimester, so on and so forth, again, do feel free to touch base and I can avail you to some of the things that are happening on campus. One of the things that I do like to do in particular is sort of try to bring some of the cohort together that have an interest in doing certifications, just so you guys can kind of keep motivating each other to stick with it, okay? So do let me know. All right, just a couple of general housekeeping matters. I think some of you might find that when you try to enroll in this class, it says that there's no room or no places left. Don't worry about any of that. Okay, it's not an issue, it's just the way the booking system works. So if you get a prompt saying you're not enrolled in this session, there's no need for concern. I'm happy for you to come along, all right? It's because for some reason, a large number of the online students are also enrolled for some courses as on-campus students from semester to semester, and as a consequence, the system doesn't quite capture things correctly, okay? So we don't have a huge amount of additional material to cover for today. The primary focuses for the remainder of the session just relate to institutional structures in particular, and some broad discussion about the way the markets are operating at present and just some commercial context for you all in terms of market size and relative size, that type of thing. All right? So I'm going to start now by just sort of touching base with you about a couple of key concepts, I think, in finance that are essential to your understanding of finance and why things go wrong. All right? So this is something that I haven't delved into too much in my text because it's a very simple concept, but it is an important one. So you will find some discussion there. But this is something that probably needs to be done in a more auditory way. As I mentioned in the past, people forget when it comes to history quite frequently what has happened in the past. And most generations are of the view that certain things have never happened before. I love the debate that people are having at present about platforms like Spotify. People are so concerned about Spotify. Have you seen those articles talking about the damage Spotify could do or Apple Music could do to industry? Just by virtue of the subscription-based models. These same discussions were happening when the printing press was created. And I can recall reading popular press in recent times around the news that was provided or covered when the radio stations first launched in North America. There was a huge concern about copyright infringement and about people losing money. And we've come to discover that radio has actually driven sales. And we've also come to discover in recent times that on occasion copyright infringement can in fact actually bolster the sales of a primary solution or indeed of music. Why am I providing you with this rather tenuous link to copyright? Well, the same is true of discussions of finance. Quite frequently when people talk about changes to models of intermediation, when they talk about changes to the financial services sector, they get really worried. They think dramatic and outrageous things are going to happen and everyone's going to lose their jobs. There is going to be some job friction. Okay, and people are going to move into new industries. But you guys are at the cusp of it. So you get to make the decision as to whether you want to join a traditional model or a non-traditional model. And that's kind of exciting. So I can recall when we first put these courses together, talking to people about the risks associated with things like securitization and the challenges associated with securitization. Sometimes things do go wrong. All right? I'd say we were one of the only courses in the world talking about the risks of securitization pre-2004. Okay?
So from time to time, things do go wrong in the financial services sector. But we need to learn from those moments in time. So what I want you guys to appreciate is that the current malaise within the financial services sector is nothing new. It happens every 20 to 30 years. There's some new issue that gives rise to these challenges. Just in the last 3 decades, we've had the Asian financial crisis, we've had the Argentinian peso crisis, we've had the, how do I put it, the various high-frequency trading-related crises that have existed for relatively shorter amounts of time. The critical thing, again, is to sort of learn from them and to allow them to inform the way that you approach markets in the future. To not be one of those naive people that's like, oh my gosh, this has never happened before. What do we do? You know, throw your hands in the air. The idea is to be informed by history. This concept comes from history. It's a very simple concept. Okay, it's as old as financial services. And the notion, quite simply, of the matching principle is that your short-term assets should be funded by short-term liabilities, and your long-term assets should be funded by long-term liabilities. Okay. Actually, I should digress. I noticed that there were a couple of students that were supposed to be in property that are in here. Just again want to mention this is not property. Property is next door. So I don't want you to feel bad that you need to sort of stick through the entire class if you're in the wrong room. Okay? So some people figured that out really, really early, but in case you haven't. All right? I remember being new to a uni and not wanting... I remember I went into a nursing lecture once. Right? And I was sitting there going, okay, this is not my class. But I waited for the break. I was like, I'm not going to leave till the break. If you need to leave, it's all good. All right? So we're all meant to be here? Good. All right, so the matching principle. Short-term assets should be funded by short-term liabilities. Medium-term assets, medium-term liabilities. Long-term assets, long-term liabilities. Why do you think we espouse this rule? It seems obvious. Very, very simple, because people don't do this. Okay? People pursue actively the lowest cost source of finance quite frequently at the expense of their business model. Okay? Has anyone been to the Glen Shopping Centre? Really? Okay. All right. Has anyone been to Forest Hill Chase? Okay. What shopping centres do you guys visit? What? Chadstone. Everyone goes to Chadstone. Why? It's so busy there. It's hectic. All right, fine. Someone said Box Hill there, right? Thank you. Good man. All right, so Box Hill. All right, Box Hill is owned or was formerly owned by Centro Property Group. Forest Hill Chase was formerly owned by Centro Property Group. The Glen Shopping Centre was formerly owned by Centro Property Group. Okay? Centro Property Group was one of the most successful property developers in the world. Australian-based property developer. One of the largest in Australia outside of Westfield. Centro pursued an expansion program in North America. How did they fund that expansion? By borrowing predominantly medium term and to some extent shorter term. Why did they do this? Because there was so much cheap money in North America. It was cheaper to borrow there than it was to borrow here. So they borrowed substantially and they started buying more shopping centres and building more shopping centres. In fact, they built over 243 new centres just in North America alone. Well, new or somewhat new. That's kind of remarkable when you think about it. Foreign enterprise being able to achieve that level of success in North America, and they were flying along. Why? Because property in that category is generally a very good investment. Because people will always try to speculate on what they can sell through a retail property-based model. They had various people wanting to acquire one or more places in the context of each of the shopping centres that they operated in North America. So they were making a lot of money. Huge amounts of money. Billions of dollars. Okay? And then the GFC happened. What happened to their business model? Well, they were still able to generate necessary yield because they were smart. They had, generally speaking, long-term leases in place. That's what you do if you're smart about these things. You get people to enter into longer-term leases, you bring assurity to your business model. So, what do you think happened next? Were they able to stave off the GFC? Unfortunately, they were not. Why? Because at the core of their business model was a very, very simple notion. We're going to borrow medium and short term because it's cheaper than long term to fund ultra long term assets. Okay? All of a sudden, North American lenders said, well, hey, we're not really keen to lend right now. It's not because you're not great. It's not you, it's me. That was the line. You guys are wonderful, but we just don't want to really pursue this anymore. So they couldn't roll over any of their debt. What do you do next? What would you do next? That's exactly right, and that's exactly what happened. Okay? And this is the industry that I'm from. I was involved in a number of projects like this, and it shouldn't happen. All they needed to do was, prior to those challenges, roll over the debt and try to borrow more long term. The problem was they pushed their business model very, very hard to generate and extract as much revenue as they could. Their treasury team said, hey, we're going to be making an extra $50 to $100 million a year doing this. As a consequence of that, all of a sudden, they couldn't refinance any of those major assets. And so they did have to call the administrators in. And also, guess what happens when you call administrators in under most pronouncements around the world in relation to insolvency legislation? That's exactly right. The receivers get appointed. So someone like myself will come in and take charge of the entire company, unfortunately, and they have no say in anything anymore. Quite literally, from that day, they have no say in anything. And the receiver manager does not take on any of the obligations of the business and has to decide what to do next. In this case, a number of the assets were rolled together, and unfortunately they were sold, but under the worst conditions. You never want to sell long-term assets in a fire sale model. Imagine going over to Chadstone and putting a for sale sign up. How much do you think Chadstone would sell for? Okay, to put it in perspective, let's base it on a simple revenue model based on a multiple. Let's say they're turning over $1.4 billion a year, conservative. All right? We're talking about, what, $9.8 billion for the asset? Maybe? That might be slight overs, maybe 7. But it's still a very, very expensive asset. No one's rocking up, in their car driving by going, oh, look, that's a great property. I think I'm going to buy that. So they had to sell these assets at outrageously depleted prices. Okay? Outrageously depleted prices. And as a consequence, only a small portion of the business model could be could stave off the administration, could address the receivership. And consequently, many of the major North American assets were sold to North American groups. A number of Australian assets were sold off as well to AMP Capital. And the last remaining assets you now see: Box Hill, Forest Hill Chase. One of the most recent assets sold actually was Brandon Park. Anyone seen Brandon Park? Brandon Park was sold for $28 billion 2 weeks ago. $28 billion, what am I talking about? No, it wasn't. Thinking of an entirely separate situation. Brandon Park. No, 32 million, sorry. Be like 7 Chadstones. So Brandon Park was sold for $28 million to an investment group led by a former AFL director. Okay, so all of these assets they couldn't carry any longer, not because their business model wasn't fantastic. Their funding model was not fantastic. Doesn't matter how good your business model is, if your funding model is bad, you can still cease to exist. All right? So this very, very simple rule I spend a lot of time on, because if I can teach you one thing, okay, in terms of my time in Treasury, it's this one thing. Okay? Don't push your business model too hard with your revenue model, because it will come back and bite you in the backside. Doesn't matter how big you are. Okay? Multi-billion-dollar companies lose out through not taking into consideration potential losses and the risk associated with not following this rule. There are occasions where you have to deviate from this rule. Okay? So we were appointed to a number of property transactions over the years, and on a number of occasions we were appointed because people found themselves close to going under because they couldn't finance their transaction anymore, and they utilised what's known as mezzanine finance. Has anyone heard of mezzanine finance? What's mezzanine finance? It's all right. That's exactly right. That's the only time you want to be looking at short-term finance for a long-term project. But that's funding of last resort. All right? Funding of last resort. When you get into a situation where you need mezzanine finance, you're borrowing large amounts of money on very high rates of interest. Okay? And the only time you do it is in that situation. And when we take appointments, we don't fund them that way. Okay? So when the receiver or manager takes the appointment, we never use mezzanine finance. We go back to the traditional lender and we try to get them to restructure the loan. Okay? When people get nervous, the instant response is mezzanine finance. What is the rate of interest on mezzanine finance? Anyone? What is the rate of interest on mezzanine finance? Upwards of 22%. Okay? That's massive. That is bad planning. I don't want to hear about any of you guys ever doing that. That's why projects go under, because of bad planning and bad funding models. All right? Sometimes it's the only option you have. And if you're not a receiver manager, it might be the only thing that you can do, but you never want to put yourself in that situation. All right, returning to financial markets proper. Our primary focus in the context of equity markets is obviously going to be on IPO activity. That's our interest in this course. We're going to be analysing new firms. We're also going to spend some time analysing existing enterprises as well. Okay? And our focus in this course is on new world business models, multi-sided platform markets, and technology-based enterprises. Everyone can value traditional models. You look at their asset base, look at their revenue yields, look at their multiples, look at their earnings. Traditional models are straightforward. Any man, woman, or child with an abacus can value one. Modern businesses are much harder to value. We're going to be spending a lot of time analysing non-traditional business models. Can anyone tell me why non-traditional business models, like the business models of Amazon and Facebook, are so difficult to value? Why are they so challenging to value? Even companies like Google and Microsoft are more straightforward to value. Apple is a hardware company, very, very straightforward to value, relatively speaking. I mean, with Apple and Google, there are a lot of momentum investors, though, which make it interesting. Those guys make it interesting because you can make money when there isn't money to be made in those situations. But, I mean, that's not the kind of speculation I want to be encouraging in you guys. I want you guys to learn good fundamentals. So why do you think it's so difficult to value Facebook? Okay, quick question. GM and Facebook. If we look at their balance sheets, what will we discover? What kind of tangible assets does GM have? General Motors. Or Samsung. Samsung then. Lots of tangible assets. So if you look at Samsung's balance sheet, they've got ARM chipset manufacturing foundries. They've got television foundries, television manufacturing units. They've got a heap of traditional IP secured through patents. Okay? They've got, for argument's sake, OEM and ODM manufacturing contracts in place. They produce about 97% of the componentry in an iPhone. It's Samsung, from Samsung. The ARM design is from ARM. Okay? That's the reality. Okay? So they've got a huge number of assured contracts and assured business positions. What about Facebook? What's Facebook's balance sheet like? What are the tangible assets of Facebook's balance sheet? Computers, maybe? Yeah? Some offices? Some chairs? Seriously, some tables? Right? How do you value them as highly as you do? Well, this is your generation even more than mine. I used to be on MySpace. It doesn't even exist now. Most certainly. I'm not a huge fan of social technology. I've been forced to be on LinkedIn because our funders said that I had to be, or they wouldn't fund us, so that was the rule. So you'll find me there, you won't find me anywhere else. But yeah, there's some truth in that. But I do think Facebook is a generally honourable company that is kind of, on occasion, losing its way. I think they started out the right way. Selling data is not cool, undeniably, in the way that they've been doing it. But setting all of that aside, how do you value Facebook? These are I mean, you're going to be doing this. If I get you an internship with, how do I put it, a brokerage group, or, for argument's sake, with a reporting team, or if you're involved in the construction of broker reports with some sort of finance media service, right? Lots of internships that you guys can be doing if you want to be doing them, right? How are you going to draw a conclusion? Let's say, for argument's sake, they actually let you put together a report on one of these firms. What would you start with? How would you value them? Okay, so just earnings based.
How do you establish an enterprise valuation when there's so few tangible assets that underlie that enterprise valuation? No, I agree with you. You're 100% correct. That's how you start. You're correct. But I'm saying it's so much more, it's more problematic. So new models, okay, new world-based evaluation models focus on user value and goodwill attaching to user value. So it's a big part of how we value modern enterprises. How do you establish the value of the user? How do you establish the revenue deriving from a specific user? Okay? How do you determine an appropriate third-party valuation for each user? How much value does each new user bring to each existing user in the context of your network valuation? Okay? Think about it. Your network valuation is what? N minus 1 squared divided by 2. Number of connections, Metcalfe's law. You would learn about that in commerce. That's how you value a network. But how do you value the aggregative benefit or the additional benefit that comes from each new member? These are the things that you guys will be learning about in the context of this program. How to actually evaluate new business models. And it is really, really challenging. I mean, the old world approach is to just look at earnings only, attach all value to earnings. But if we were to value Facebook based on earnings, how much would you value them at? Probably nowhere near as much as they're currently valued. Maybe 1/10 of what they're currently valued. I mean, they're trading at an outrageously high multiple. Their price to earnings multiple is huge. So these are the things I want you guys to sort of start thinking about, all right? We know how to value traditional models. We know how traditional models work. When someone makes something, we know how to value them because they have assets they use to make that. They then sell that thing. That thing has a particular margin. That margin generates earnings. Those earnings we then discount back to the present day to determine the value of the firm. When it's a company like Facebook, when it's a company like Amazon, when it's a multi-sided platform business, when there are so many elements to the business model, you need to really start thinking outside the square. You need to start thinking differently about how you need to go about engaging in evaluation. It says press any button. I'm pressing a button. One sec, guys. Never seen this message come up before. Sorry. Don't do this to me. All right, it's about to shut down for some odd reason. Just going to need to restart it. Sincerest apologies. I don't know which one of the any buttons I didn't press just now. I pressed about 50 of them. Okay, I'll just need to look at this on a tiny screen, that's fine. All right. It's always something week one. Okay. Okay. So, direct versus intermediated finance and direct versus intermediated markets. What is intermediation? Intermediation is the process of a firm sitting between the deficit unit and the surplus unit to ensure that both parties' needs are addressed. So, essentially, it's the basis for modern banking. The financial intermediary sits between those that have more money that they need that they deposit in the bank, and those that have less money that they need that borrow from the bank. This process of intermediation creates two concurrent contracts. With intermediation, there is a contract between the lender, the depositor, and the bank, and the borrower and the bank. With a direct financial transaction, there is no intermediary go-between. There is one contract. That's the key thing to remember. There's one contract between the party borrowing funds and the party supplying funds. Direct finance is very, very important to many modern enterprises.
when I used to work in treasury operations with Ford, we had 11am agreements in place with a number of other large corporations. So if we needed like $10 or $20 million, we wouldn't go to the bank. We could borrow it from Coles-Myer, for argument's sake. And if they needed money, they could borrow it from us. It was just smarter than involving a bank because it was cheaper. And the bank would obviously charge us a huge number of fees, the various costs attaching. That's why direct finance is so beneficial. Generally, direct finance has been a segment of the market that most borrowers have not been able to access. Most people use intermediation because it's easier, but much of the fintech innovation that's happening at the moment, particularly in India, okay, is around direct finance, creating mechanisms through which people can pool money for lending purposes. It's happening more and more. It's happened in the context of microfinance for a number of decades, but we're now seeing larger amounts of money being lent and borrowed through direct finance-based models. All right. If they're so beneficial, why do people use intermediation? Well, intermediation is beneficial because with an intermediary, you carry very little risk because of the credit risk diversification. The intermediary is borrowing money from various parties. It's lending money to various parties. So you get this credit risk diversification benefit. You also get the benefit of diversification in terms of maturity structure. People aren't going to be borrowing money at the same time. People aren't going to be depositing money at the same time. That maturity diversification benefit is really, really valuable. Okay? All right, very, very simple diagram. I know, don't want to insult anyone's intelligence. That's essentially all that's going on. All right. That first assertion in relation to diversification, in part, has a great deal to do with asset transformation. The bank can make assets that others can't make through its pooling ability, through this pooling capability that it has. It brings all these divergent assets together, it pools them, and it can create new synthetic products. Okay? Already talked briefly about maturity transformation, so we'll skirt over that. Yeah, we've talked about that already. Another critical benefit is obviously the distribution of cost benefit that comes with an intermediary. The intermediary is spreading all of its costs out over a large network, and as a consequence, each person pays less. There's been a lot of debate about this because obviously in recent times, the Australian banks have been subject to a major banking sector inquiry, and one of the key claims of this inquiry has been that the Australian banks have been overcharging. Okay? There are a number of schools of thought in relation to this. The banks have taken, for those of you with an accounting bent, what is known as an activity-based costing approach to banking. They're trying to assign costs most appropriately to activities and then assign them to individuals. Many argue that they've overstated their cost structures and are using it as a substantial revenue source. Okay? It's a debate for another day. Okay, when it comes to wholesale versus retail and money versus capital, these are just key terms you need to be familiar with because we use them a lot in finance. They're not actually formal market separations. There's no separate wholesale market that you walk into and a separate retail market that you walk into. When we talk about wholesale versus retail, we're just talking about the number of zeros. Okay, the amount of money that's being borrowed. You'll have different wholesale and retail lending teams, but the money is all the same, the segment is all the same. There's substantial movement between the two. Okay, so retail markets are household level transactions, generally speaking. Wholesale market transactions are typically substantially larger. Okay, but just try to remember the terminology, remember the vernacular. Okay, money versus capital markets. Again, just terminology, just vernacular. A money market transaction is a transaction involving an instrument with maturity of fewer than 12 months. Capital market transaction involves maturity of greater than 12 months, money versus capital. All right, so these are some of the markets we're going to be talking about in this course. And in particular, we're going to be talking a lot about the bill market and the commercial paper market, and obviously central banking policy. It is a financial markets course, but you can't avoid some monetary policy. All right, so it's going to be at least a week of it. All right, so yeah, something to look forward to. All right, capital market transactions are just longer maturity transactions. That's all that you need to remember here. Okay, in the context of the capital markets, where our primary focuses are the government debt market and the equity market. Okay, at this level, in this course, they are our primary focuses. Okay, so just to sort of pull it all together, I want you guys to appreciate just how integrated financial markets now are. I'm guessing many of you trade in shares. I'm much more interested in early stage investment and venture capital. It's something that I'm generally more passionate about. But in saying that, I'm guessing many of you have probably a great deal of interest in traditional equity markets. With globalization, it's now very straightforward to trade in any security that you want to from anywhere in the world. If I ask, how many of you do actually have like a trading account with a bourse or exchange? Probably unlikely to have a direct trading account, probably likely to have some sort of secondary service account with someone like CommSec or another provider. Has anyone done that? Okay. For those of you that haven't yet, I'd strongly encourage you guys to, at the very least, set up one of those fake accounts with them, one of those accounts with toy money in them. So you can set up an account with IG Markets, okay, that allows you to trade with toy money, if that makes any sense. So it'll be the same platform that everyone else uses, but allows you to just get a feel for how market trading and that type of activity kind of works. So IG Markets is a great provider. I know a number of people there. I guess that's why I'm a little bit familiar with it. But there are many others as well. You could use CMC Markets. It's another great provider. Or you could just go with one of the major banks. They all have a service of this type as well. So CommSec is a very, very popular one in Australia, CommSec being run by the Commonwealth Bank. All right? I encourage you to do this because it's important to just start to get a feel for these sorts of things. It feels very esoteric if you sit in a classroom and have someone talk at you all the time. Much of your learning will actually come from actually engaging with these markets. And it doesn't just have to be this market. As I said, by virtue of globalization, you can trade in securities anywhere in the world from Australia. Okay. How many of you guys have ever had an account of this type? Anyone? All right. So a few of you have, which is good. Yeah, look, it is important. It's free. CMC Markets, IG Markets are both free services, so please consider utilising them. Beyond that, it's really good to actually just to start to get a feel for the markets by spending some time with the data. So if that's a little bit confronting for you, setting up an account and registering and all of that type of thing, I'd strongly encourage you to consider an alternative, like using a service like Yahoo Finance. Okay? Yahoo Finance is a really, really great, simple introduction to financial services. You can track a number of different securities. You can set up a basic tracking portfolio. It just allows you to sort of look at what's happening within the market. So at the very least, consider one of those. By virtue of your study with Deakin, you also get subsidised access to the Australian and the Fin. I think it works out to, for students, around $57 a year. Okay? I mean, it's a decent amount of money, but considering you actually get the physical copy delivered to your house, I think every weekend, I think that it's pretty worthwhile. And you can only do that while you're a student. It's substantially more expensive when you're not. So consider one of those services as well. Are you guys aware of all the free stuff you get here? Okay, so let's take a moment or two to have a look at all the free things that you get because you're a student, because it is kind of worthwhile. You get a whole heap of free things, particularly software. All right, so I'm just going to show you some of it. Please bear with me because I have to use that screen up there because I just want to shut itself down. Okay, this is remarkably odd. All right. See how good my touch typing is. All right, there we go. Okay, so in terms of software that you get, this is obviously your starting point. You get access to IBM SPSS Modeler. All right, if you're in industry, that costs you $14,000. Okay, I'm not even joking. I know it's absurd, but you actually get free access here. You also get access to Stata, but you need to get approval for that. If you want approval, you can email and I'll arrange for access. Again, it's very, very expensive application. Teaches you a little bit about time series modeling and just basic data modeling. SPSS Modeler is another really, really great tool for those of you that are keen. In terms of data access and API access, we also have access to Bloomberg, okay? You don't all get standard access to that just yet. You do need to apply for that one as well. But for those of you that are keen, you can get access. You can also access training. Okay, is everyone familiar with Bloomberg? Yeah, for those of you that are keen, I'm more than happy to arrange some training sessions in Bloomberg, okay, if you're interested. For those of you that aren't familiar with it, Bloomberg is a standard data service that a number of financial services firms use to access complex financial data from many different markets. It's run by a very quirky individual in Michael Bloomberg, who's obviously been very, very successful with it. We pay around $40,000 a month for the service. It's not cheap, so it is worth you guys using. It's predominantly used by academics at the moment, but you are entitled to use it. There are a number of hotkeys and there's a number of simple code frameworks that you can use with Bloomberg to automate data access. Learning those things makes you far more employable if you want to work in the financial services industry. Okay, so have a think about those things as well. I'm digressing slightly. The point of that final slide was really to just sort of make you guys aware of just how global markets are and to encourage you to sort of look beyond your borders when it comes to investment and markets generally. There are lots of interesting things happening in lots of different contexts. We have a number of our senior Indian students and Chinese students here that are now involved in our startup program. Okay, they're building fintech for India and China. Okay, these are things that you guys can do. I know it probably sounds like a pie in the sky thing right now, but I had a student who was sitting where you guys are 18 months ago that is now part of a startup incubator that is funded. Okay, so it can happen if you put the effort in. These are the things that you guys need to be thinking about in the context of, I guess, your global opportunity. And try to leverage your network as much as possible. If you are keen to come along to some meet and greet sessions where you can meet people that have done these sorts of things, I'll put the contact particulars for these programs on the cloud, and you can have a look at them, and I'll progressively update those postings with dates and times of events that you can attend for those of you that have a passion for this. But again, the goal of that last one is to really just sort of value to the fact that it is far more important to consider the things that happen outside of the classroom. Okay, academics shouldn't say this, but I will, than the things that happen within this class. All right? I'm sure you're all going to do well in the context of this class if you pay attention and you follow the material. What happens outside of this class will determine your success far more than what happens within it. All right, so those of you that have a keenness to pursue opportunities within financial services more, please touch base early within the program. Don't leave it till, final trimester. This morning alone, I've had probably 12 email from people that have obviously come back for their final trimester. And this is obviously day one of coming back from their final trimester, who have now said, hey, I want to do an internship and placement. Can you get me one for next week? Really not that easy to sort of do that quickly. This is the time to start thinking about these things. Again, I am digressing, so I'll leave it at that. In terms of protocol for the remainder of the program, obviously the material that I post online will be made available approximately 1 week before the session. You're entitled to print out that version of the book. I will upload a one-page version. That's obviously a two-page spread, which students prefer because it minimises printing. If you want the one-page version, that will go up online tonight. In addition to that, I'll provide you guys with free access to the books platform. Okay, please don't register for the books platform until I provide you with a coupon code, okay, because it's a $99 a year fee that attaches, but you guys will have free access for the 3 years that you're here, okay, or 2 to 3 years depending on your program length, okay? So please wait for that code and that link. That'll provide you with access to a number of videos, audio files, and additional books that will help you in the program. For those of you that want to study ahead, I've also uploaded the majority of short form lectures, so lecture summaries, onto that platform as well. So if you ever want to study ahead, you can just log in and access material for subsequent weeks in advance, for those of you that like to do that kind of thing. There are probably only a handful that do, but for those of you that do, the program will cater for that as well. If you have any questions or concerns about anything, and it's natural to feel a little bit frazzled week one, okay? Because you haven't done any of this before, you haven't talked about financial services for a long time. If you have any questions or concerns about anything, if you want a bit of a confidence boost, if you want to have a chat, you can certainly call me, and I'll talk you through what we've covered, if there are things that are causing you some consternation or worry. With that said, come week 3, I think most of you should be feeling pretty comfortable in the program. Also bear in mind, everyone comes into the course with very different levels of experience. Our online group is generally very experienced. We have a number of GM level and C level people in the program that are online, a number that are obviously on campus as well. I guess the cohorts can be quite varied. Don't be perturbed or alarmed or concerned if there are more experienced people in the program than you. Everyone is here to learn, and let's try to approach it with that same level of collegiality that we would any academic program. But the reason I mention that is often people feel really confronted by using the portal, okay, and asking questions. It's a really valuable way to do it. I do find people email me a lot. I don't mind, okay? But if you do email me and you ask a really good question, I might just respond with, look, here's the response, but can I post it on the portal as well? Just so other people can benefit. But if you are feeling a little bit frazzled, a little bit perturbed, rest assured, I'm sure other people are as well. And in a few weeks' time, it'll become much more straightforward. I really need to emphasize these first 4 weeks in particular are very, very important because we do a lot of financial maths, week 3 to week 5 in particular. We cover off on a lot of theory next week and the following week as well. Okay? So this initial portion of the course is particularly important. The other thing that I really want to emphasize is that I know that you'll have a lot of assignments in about 8 weeks' time. Try to not miss sessions around that time, if you can, because they're important weeks in terms of exam preparation. I specifically gear the course in such a way that we do 3 weeks of exam preparation. Our first week of exam preparation is week 5. Our second week of exam preparation is week 8. And the final week of exam preparation is the final week of the course. Okay, so don't miss those weeks just because you're working on assignments. Find the 3 hours somewhere else if you can. Okay? I'll concede that for some of you, you've probably not done some study for a while. That's going to present some challenges, but bear in mind, everyone's in the same boat. And the thing to remember is, if it is around an assessment time, please bear in mind you need to apply for consideration, applications for consideration and extension, a minimum of, we generally say, a week before, unless something very, very urgent comes up. Try to sort of have that dialogue very early in the piece. The other critical thing to remember is if you are feeling like you're falling behind in some way, I'm only a phone call away. Jump on a Skype for business or give me a call. I'm very, very open to receiving calls even later in the day. Up to 7 in the day, I'll probably answer. Unless I'm in a bad mood, no, I will answer. So if you call anytime before 7, we can have a quick chat if you're feeling like you're in need of that additional assistance. All right? So please make sure you take down my particulars and you do that. For those of you that aren't very familiar with financial mathematics, okay, maybe take a few moments early in the course to just avail yourself to the pricing models around some of those key instruments. Okay? Or at the very least, make sure you pay judicious attention to those weeks. Okay? Outside of that, I think you're not really going to be presented with too many challenges by this course. This is a first level course. Okay, so this course will feel different to subsequent courses that you do, where the ante is upped well and truly. Okay? So the goal is to sort of really try to get as much as you can out of the course at this level. Those of you that are going to read for CFA, this course covers between 50 and 60% of the CFA program. Okay? So having done this course, and with some independent preparation and study, you should be able to attempt CFA level 1. Okay? So have a think about that as well. I'm going to stick around for the next 20 minutes or so here, and shortly thereafter I'll be level 2 of the corporate centre. If anyone would like to have a chat about anything, please feel free to pop over and say hello. It's been lovely getting to know you guys. I do hope that you talk to me a little bit more next week. Really nice. If not, I look forward to talking at you for the next 11. I'll see you guys next week. How you going?
Second time is clear.
Yep.
So I didn't know like you international finance as well, right? So unfortunately, I'll be taking it to the next year because
I'm going to be taking it then. I have the first half of the year off. Next year you'll have Aziz. He's lovely.
But still, I have another student. I'll be taking the research component of my master's.
Oh,
so
cool, good stuff.
I'll be in Sri Lanka at that time.
Oh, good.
So I might have to take it online.
Oh, good.
So would that be a problem?
This subject?
No, the finance.
I don't take that. I won't be taking it. I wouldn't think so, but there's a lot of time series econometrics. But
I'll be taking economics.
yeah. Look, they don't examine you on the econometrics part in the course, really. It's just for the assignment. The assignment, yeah. We do a bit.
I was going to get a student's HATA and
SPSS, yeah.
not SPSS.
SAS.
Yeah.
I don't think you get free access to SAS. Oh, cool. Who are you working with? Okay. Okay. Cool. Mong Shang Li. Yeah. So, you said motion because we have someone else. Yeah, no, she's lovely. I'm sure that'll go well. She'll be able to organise one for you then. If she's using SAS, then you'll have to contact her, and she'll get faculty approval. You could find out. You can log in, right, and have a look at what's on. I don't think SAS is free.
I just think what everything is about.
Yeah, and it's because SAS is very different. So, if someone uses SAS, that'll be what they know. And so you won't be able to use it. Yeah. They'll give you a free license. If you're doing the subject, then as a research subject, they'll give you a license, don't worry. Yeah, best of luck. What's your project? Okay. Okay, cool. Well, best of luck.
Thank you so much.
Yeah. Yeah, so valuing the old businesses and the new ones type thing. The GM versus Facebook thing?
Oh,
No?
yeah, that was,
Oh, the unrelated thing? Sorry, I thought you were talking about that. Sorry.
I'm a slow rider.
That's fine.
Yeah, I'm very similar to what you're saying about the accent and the general mentoring group that we're talking
Yeah, cool. Drop me an email and we'll start a dialogue.
about. No problem.
Yeah, that sounds like the best way to do it. Yeah, this trimester I'm only really sort of active here on a Monday.
Yeah.
So it'll be mainly Mondays and Wednesdays that we catch up. But next trimester and going forward, I'll be here more. Yeah, it's a bit of external seminar work I'm doing at the moment too. So, but no, you can still catch me in my office in the days that I'm here. Or if I'm not in my office, I'll be in the corporate centre. I tend to prefer that space because it's much nicer.
Yeah.
The one right at the front.
Edgar Road.
Yeah, exactly. Yeah, if you look at our offices versus that space, our offices they feel like little boxes.
Right.
I don't know. Have you been to the finance wing? It's all glass, like a glass box.
I've been over that way. I've seen it.
Yeah. So I'm around the corner. So if you go, if you come into the lift on level 4,
Yep.
you walk down the hallway. I'm just around the corner. So we have one of the sort of nice spaces that's kind of facing the courtyard, the trees. So on that side, yeah. So if you just go out and lift, turn to the right, but just email me, I'll email you back straight away.
Okay, no problem. The other thing is, I've got an NBN problem that cut my internet.
Have they?
And,
I know a lot of people at NBN. They're working hard. It's not easy. No. Well, the technical issues I've encountered have been pretty full on. But yeah. So you don't have any internet?
not at home, I don't.
Okay.
It makes it difficult. I've been thinking,
Well, look, I can see if I could. Do you want me to shoot you the lecture notes by email or something? Do you? Or but either way, you'll still need to download them somehow. So
I presume we have to come here to do it.
yeah.
But I'm just wondering, can I get a laptop through the university?
Can you borrow one? I'm not sure. Quite possibly, I could find out. I know we did have a program that I used to be involved with where we would give away laptops, but I don't know if that's running anymore.
Right.
Yeah, I think all those things kind of stopped when some of us left. So I don't know if they do that anymore. I know that you couldn't have one when you're in the library at any time. I don't know if they do the old program where you could take one for longer. You do have, with Samsung, there's an agreement in place where you can get like a tablet with 2 docks that you could use for the course for like $180, like the big ones with a keyboard. That's a pretty low cost kind of way, I guess, to get into it. Oh, sorry, my colleague's about to start. So that could be an option. I'll just log off so this chat can get on.
So I need to go to IT or the IT department to organise.
No, you'd probably have to go to student services.
Student service.
I'll show you. I'll walk you over.
Yeah.
What the heck is it doing? Oh, they haven't got it here. Why don't let me shut down from here?
Sorry, I can't see. I've got my glasses on. I couldn't use that screen.
That one over here.
Okay, cool. Thank you.
Thank you, Jane. Sorry,